here. And we should be able to get through this. One of the things that I wanted to do, hold on just a second because I want to pull up your homework problems. We went through a few on Tuesday, but there are a couple new concepts that we're going to cover today, so I want to be able to kind of give you some assistance with some of these problems. Through this one, didn't we, together? Alrighty. Let's try this one to get started here, just to kind of refresh our memory on some of this. This is a multi-state problem. So in April of the current year, Freeman Steel Company transferred Herb Porter, so same company, right? So one employee, same company, is not switching companies. Transferred him from its factory in Nebraska to its plant in Ohio. The company's SUTA tax rates, based on its experience ratings, and we're going to go through experience ratings today, are 3.2% in Nebraska and 3.8% in Ohio. Both states base the tax on the first $9,000 of each employee's earnings. This year, they paid Herb Porter wages of $21,000, $2,900 were paid in Nebraska, and the remainder in Ohio. Compute the following. Okay, well, let's do the easy one first. So FUTA, how much of his wages are going to be subject to FUTA tax? I see a couple of lips moving, but they don't want, there's no sound that wants to come out. 7,000, right? Thank you. So, get my calculator up here. So the amount of, and what they want here, so the amount of net FUTA tax on his wages, so they're asking for the actual tax that is going to be, whoops, hide. And again, the magic number is $42. That's the most that, if you're, as long as you're with the same company, that is the most that any company is going to pay in FUTA taxes on your wages during the year. It's that $42. So, provided they have the, they do not have a credit reduction, right? So we're assuming that they do not have a credit reduction here. So for Nebraska, its experience rating is 3.2%, meaning that's the tax rate essentially, on the first $9,000 of wages, but they paid $2,900 in Nebraska, right? So 2,900 times their experience rating, 3.2%, so 9,280. Okay. Oh, sure. Now, here's the more complicated part. How much SUTA tax must they pay for Ohio wages? Since this is the same company, they are going to get a credit for the wages that were earned in the other state. So that $9,000, we get to reduce it by $2,900 because they already paid on $2,900 of SUTA taxes in Nebraska. So total of 9 minus, just subtract subtract the 2,900, so 6,100 of wages is going to be subject to 3.8% tax in Ohio. 231.80. Does that make sense? They're going to get credit, and again, it's only because it's the same company. If it were a different company, then that $9,000 of his wages in Ohio when he transferred there would be subject to that 3.8% tax. Any questions on that? That make sense? And it's a credit against the wages, not against the taxes paid. Okay, so you're not going to get, since the tax rates are different for each state, it's the wages that you get a credit against. Let's see. Now let's look at this one. We've got Ron Valdez, worked for 2 different employers. Until May, he worked for Roland Construction Company in Ames, Iowa. Hey. Earned $22,000. State unemployment rate for Roland is 4.6%. He then changed jobs, worked for Ford Improvement Company in Topeka, Kansas, and earned $29,500 for the rest of the year. State unemployment rate for Ford Improvement Company is 5.1%. Now, in this case, we're going to have to look up what the wage base is in each of these states. So we already looked at Iowa last week, and we know it's what, 34,700 or 900. I can't remember if it's 7 or 900. So we don't really have to look that one up, although we could. Here we go. So Iowa, it's the first, 800, 34, I was wrong on both of them. First 34,800 in Iowa. And then he moved to Kansas, and it's on the first $14,000 of wages. Why do we have 2 asterisks? Oh, they allow voluntary contributions. All right. So, all of the wages that he earned in Iowa are going to be subject to the SUTA tax. So at Roland, 22,000 over 6, 1012. At Ford Improvement Company, however, even though he earned 29,500, only the first 14,000 on those wages are going to be subject to the SUTA tax times 051, 5.1%, so $714. Oops, what? All right, FUTA tax, taxable payroll, times the net. Why does it say FUTA? Oh, total, I'm sorry. I didn't read the last sentence. Determine the unemployment taxes for FUTA and SUTA that would be paid. All right, so take this out. So 1012 is the SUTA tax. How much in FUTA tax is Roland? How much of his wages for FUTA tax purposes are going to be taxable at Roland Construction? 7,000, right? So that'd be 42. So 1012. 1054. That's what happens when you don't read the whole question. And then what about Ford Improvement Company? How much of his wages are going to be subject to FUTA tax?
Would it be 7,000?
It'd be 7,000 again, right? Because it's a whole new company. So we're going to add 42 to that 714. 756. Oops. 756. There we go. Okay. So you can kind of see the difference between when you're working for the same company with regard to SUTA and when you're working for a different company. Questions about that? Okay. So let's start, we're going to start talking about, and I'll come back to this because I've got some problems in here that I want to work on. So we looked at, actually this is a great thing to keep up here. This is a lot easier to look at than what they've got in the ebook. So let me get all right. So states have these pooled fund laws, which means the cost of those unemployment benefits are spread among all of the states, just like any other insurance. It all goes into a pool, and then amounts are paid out, but they keep track of how much has come in from each employer, and then how much goes out as well as a result of claims against each employer. So if an employer has a negative balance, meaning more claims have been paid out than premiums have been collected, the employer is going to see an increase in their payment rate, in their tax rate. Okay, but it doesn't mean that individual employees are at the mercy of those employers. All of those funds will be covered. It's just that it may be coming, because there's a negative balance, it's coming from other employers that have paid in additional funds. Now, if an employer has paid in additional funds, so they paid in more than they have needed to and have fewer claims, then their rate is going to go down. So it's all based on, what the prior experience is with that employer. Now, when you are a new employer, we have an initial contribution rate. So just like, remember we had for the schedule for 941s, when you're first starting out, you don't have any history of making those payments, and so you start out as a monthly contributor. Well, there are initial contribution rates as well, which vary by state as to how much each employer will pay. Iowa, I can't remember off the top of my head what Iowa's initial percentage is, but I think it's also determined by industry, so the industry that the employer is working in. So once they have established a history with unemployment, then that's when those rates will be more reflective of what the employer's experience has been with regard to claims and benefits, or claims and premiums that have been paid. There are some states, and we'll pull this up here because it'll show you, there are some states where the employee does have a portion that they have to pay. This is only for SUTA. For FUTA, employers cannot pass any of that on. The employee does not pay any portion of that. But for SUTA, there are certain states where that may be the case. So for example, we've got Alaska here. We've got the percentages, the employer minimum and maximum, and then we have 0.56% on the employee side for the first $45,200 of income that the employee makes. Also, California, 1.1% on the first $145,600. Hawaii also has an amount that the employee has to contribute. You can see Iowa does not, but if there is any amount that the employee is required to contribute, it would be listed here in this column. Now, some that they have listed here, like Puerto Rico, Rhode Island, it says it's disability insurance. So these are amounts, it's not unemployment insurance, but it's disability insurance that the employee is required to contribute toward for employees within that state. All right. Sorry, where am I? Which slides am on? All right, so how do they figure out this experience rating, or this percentage? Well, of course, each state is going to be different with regard to the range of percentage of tax rates that the employers are going to pay. But generally speaking, the most common formula that's used is this reserve ratio formula. And this is the problem, one of the problems that I want to go through with you today, because I know from experience that a lot of students have kind of struggled with this concept. We're going to do and actually I'm going to This is a good equation to just write down and have in your back pocket. So contributions minus benefits paid so the amount that the employer has contributed to the fund minus what they've paid in benefits divided by an average payroll. And your problems will tell you how to determine what that average payroll is. Generally speaking, it's over probably about a 3-year period what the average payroll would be, but then this reserve ratio is used against a chart that the state maintains to determine what the percentage is, what the tax percentage is. So. And again, so contributions would be over a certain period of time, how much they've built up in contributions over a set period of time, minus benefits that have been paid over a set period of time, divided by an average payroll over a set period of time to get the ratio. That ratio is not the tax rate though. That ratio is then used to determine what the tax rate is based upon a chart that's kept by the state, okay? And as I mentioned here, and I already mentioned, positive balance employers will experience lower rates. This means that the employer has built up a balance in reserve, sort of like their checking account. They've got a positive balance, they've got no fees. You go into the red on your checking account, you start incurring some fees, right? You got to make that good. Negative balance employers will experience higher tax rates in order to make up for that. So I gotta find the problem that I'm thinking about here. Oh, before I do that though, because I think this problem exists. So there are some states that will reduce the tax rate if an employer makes additional voluntary contributions. Okay, so if they put more into the system, they can then reduce their tax rate for the coming year. Okay, and so the problem that I'm thinking of anyway involves a question around that. Let's see here. I want to come back to that one. Okay. I think this is it. So it can be it's a lot of information. So you can see here, this is the chart that I was talking about. So the reserve ratio, and this is just specific to this particular problem. Don't take this as gospel here. Reserve ratio, once we've done this calculation, if our reserve ratio is between these amounts, then this is going to be our corresponding contribution rate moving forward, okay? So let's take a look here. Oh, and this one, it kind of goes backwards. As of June 30th, computation date for the 2023 tax rate, Sanchez Company had a negative balance of $1,140 in its unemployment reserve account in State A. The company's average payroll over the last 3 12-month periods amounted to $540,000. The unemployment compensation law of State A provides that the tax rate of an employer who has a negative balance on the computation date shall be 7.2% during the following calendar year. All right, so the smallest, what they're asking for here, the smallest voluntary contribution that Sanchez Company could make in order to affect a change in its tax rate. So in order to get this reserve ratio down, or actually up to a higher amount, so we're going to have to use algebra here. Sorry, I know you thought you'd never use algebra again, but here you go. Let's see. so 540,000, let's see, 7.2%. Negative balance on it shall be 7.2% during the following year. Okay, so what we want to do is get them down to a reserve ratio of 0 to between 0 and 1%. Right? How do they do this? Actually, we're gonna. I think I went too far on this, but let's use the example as our guide here. Okay, so we've got our chart here. In this case, this company, average taxable payroll of $330,000. This is the base. Oh, can't see it. Sorry. This is the base that the state uses as the average payroll. As of June 30th, the credits to the employer's account exceeded the benefits paid by 68. Now, in this case, we have a negative balance of 1,140. In this previous example, we have a credit balance of 6,800. Thus, the 2023 reserve ratio is 2.06%, which they get by taking the excess. So we've got our contributions minus our benefits paid. They get 6,800 is the numerator in this case. So in our case, the numerator is going to be negative 1140, right? So negative 1140. And here divided by 330,000. In this example, it results in an assignment of a 4.4% tax rate. So what they did was the 6,800 divided by 330,000 gives us 0.0206. So it's between 1.8% but under 2.2%. So this is where they're getting the 4.4% in this problem, is by doing that calculation. Okay, as shown in the preceding table. If the employer's 2024 total taxable payroll were 390,000, so the average taxable payroll that they have here is 330,000. But now looking forward, if it totaled in the next year, in the upcoming year, 390,000, that 390,000 would be multiplied by the 4.4% to get a total tax of 17,160. So, and that's where that comes from. Okay. If they make a voluntary contribution into the state fund within the time period specified by state law, the tax for 2024 will be less. For example, the company contributes $460, the reserve ratio will be 2.2%. So by contributing, you can see we start out with the 6,800 as the numerator up here. If that were increased by $460, that then changes their reserve ratio to 2.2%. So the rate would be reduced to 3.8% from 4.4%. Okay? So that's the crux of this question. How much has to be made in order to reduce the rate? Let's see. So we've got 7.2%. So what we want is to bring that down to 6.7%. So negative balance in its unemployment account, company's average payroll over the last 3 months is 540,000. So obviously this is what's going to get us down to below this 0% rate. What we're looking for is what does this number have to be in order to get us to a reserve ratio of 0? So, right now we're at negative $1,140, so this is our X here. Did I have that right? No, sorry. So, negative 340, this gets us to, sorry, negative 0.002. So we have to increase that. So this is our reserve ratio here. Sorry, you're watching me go through. This was not the one that I was thinking of, so now I have to go through this from scratch. It's good for you to see me struggle. So, smallest voluntary to affect a change. So we need this to get up to 100%, and it's 0.002. All right, so let's see here. So if we get that, all right, bear with me for a second here. I'm not quite sure how to do this. Are you doing the calculation, Carson?
Well, I was just trying to find like just random, well, I guess not random, because my number's a little different.
Mm-hmm.
So I just put in the 1190 and it was the right answer.
The 1140?
For yours it would be 1140.
Oh, okay, you've got 1190. Okay, sure, to get that to 0. Because in the numerator would be 0, and then it would be at 0% or more. So the amount of tax savings, yes, you're right. So the amount of tax savings as a result of the voluntary contribution if Sanchez Company's taxable payroll is $610,000. So we're gonna save 0.5%, right, on our contribution rate, because it was gonna be 7.2%. Now it's gonna be 6.7%. So 0.5%, let's look at the difference here. So if we had 610 times 0.072, so 43,920 at 7.2%. And at 6.7%. Obviously, we can do 0.05, but I'll show you the numbers here. So. $4,870. So the difference between those two $3,050. But this is not our tax savings. We've got to take into account the fact that they had to pay $1,140, right? In order to get that $3,050, they had to pay $1,140. 1910. What's the difference? Oh. more extensive. So, we've got Carlson Software Company, located in State H, enables employers to reduce their contribution rates under the experience rating system. From 2009 to 2018, companies' total contributions to state unemployment compensation amounted to $14,695. For calendar years 2019 to 2022, so that's 3 years, contributions rate was 2.7%. Contributions of each employer are credited to an account maintained by the State Unemployment Compensation Commission. The account is credited with contributions and is charged with unemployment. Okay, so we know that. Starting January 1st, 2023, the contribution rate for all employers in State H is going to be based on the following rate schedule. So in this case, we've got a different rate schedule than what we had before. The annual payroll for calculation purposes is the total wages payable during a 12-month period ending with the last day of the third quarter of any calendar year. So we are going to start with the fourth quarter. These are the 4 quarters that we're going to use. We're not going to be using quarters 1, 2, 3, 4. We're going to be using quarters 4, 1, 2, 3. Okay. So the average annual payroll average of the last 3 SUTA tax rate for the year is computed using the information available as of September 30th of the preceding year. Unemployment benefits became payable to the company's qualified unemployed workers on January 1st, 2009. Between that time and September 30th, total benefits amounting to $15,100.90 was charged against the employer's account. Okay, so they want us to compute the contribution rate for 2023. So that would have, again, we have to figure out, using our calculation here, our contributions minus the benefits paid over our average payroll to get to our reserve ratio, and then we'll apply the appropriate contribution rate. All right, so we've got, here's the amount. So the amount of, and we're going to use the taxable payroll. Here it is. All right, so total benefits were $15,100. I have that right, so $14,695. I gotta count my numbers here. Okay, so let's get our first our annual average payroll. So we're gonna take, so for 2019-20, okay, so we've got 12,500. 47,300. I think it's the average taxable payroll. Let's see. Oops. 13,750. I'm getting it from these columns here. 13,750 plus. $2,400. Our average between those. 39,600 is our total divided by 3. 46,533. Decimal place, let's see. Round to the nearest. So our, here, total benefits, well, falling below benefits paid is gonna be 7%. I guess I didn't need to do that whole, oops, it's not 7%. Contributions minus benefits paid. Oh, sorry. Benefits were charged, 15. Okay, what do I have? Total annual payroll for the past 1 year, yeah. Alright, well, sorry about this, folks. I thought I remembered how to do this. Carson, did you look like you've got, no?
No,
Okay,
no.
okay. Alright, well, let's work on this together then. So, we're gonna take our total annual payroll for the past, so they want the total, not just the taxable. Alright, so that's one of my mistakes there. Get our reserve ratio. So let's get the total instead. So we are still gonna use those 13,000 plus 48,250. Alright. And then I'm going here. 12,500 plus 13. 50. Whoops. I think I used the wrong numbers there, sorry. 13, 11, okay. Plus 13. Okay. And then 14. 42,650. Average here. Plus 41,350 divided by 3. 47,11667. Make sure that this is last. Yep. 650. All right, so we got the average, the balance in the reserve account divided by, so our balance contributions minus benefits paid is our reserve ratio. Total benefits were charged of 15,100. Total contributions contributions. So from 2009 to 2018, okay, this is why I don't think I need to use this. I need to use the taxable payroll to see what the contributions have been, because the rate has been 2.7%. So now we have to take the total of those three. So 2019, are we going to start with the first one or not? Okay. So the $14,695 that was used up here, that was for the period of 2009 through 2018. They only gave us partial information here. We also have to figure out for 2019 and 2022 how much additional was contributed. Okay, so we're going to add that. We have to calculate this amount, and then we have to add this to get our total contributions. So for 2019 to 2022, let's see. My question is whether or not this is, because this would have been, I don't know if we're starting from this fourth quarter, which doesn't really make any sense because we're not including 2019, but we don't have the full 4 years. Oh, inclusive, I guess I mean through. Okay, so now what I'm going to do is figure out how much their contributions were in 2019, 2020, and 2021 through 2022. Okay, so what I'm going to do here is add up the taxable payroll and multiply it by the tax rate. Okay. So 175,600. This is for 2019 through 2022 times 0.027. So we've got, what did I say that number was? 175,600. And we've got 4741.20. So from 2009 through 2018 inclusive, so that would mean through the fourth quarter, they contributed $14,695. For 2019 through 2022, they contributed $4741.20. So now we've got to add those two together to get the total amount of contributions. So take this out of here. So we're going to take 14,695. So this is again 2009 through 2018, and then 4741.20. This is for 2019 through 2022. Oops, 41. Does everybody have that average written down there? 41, 667. Wasn't that the average? Payroll. All right. So add these two together. 6, 3, 14, 19, 436.20. So these are our total contributions. Total benefits paid during that time. Let's see. Make sure that that's. So unemployment benefits paid between January 1st, 2009 and September 30th, 2022 were $15,190. All right, so we're going to take our contributions, 19,436.20 minus 15,190. Divided by our average payroll. Was this the number? Did I wrote that down and then I erased it. I think that was it. It's in my history. I think that's what it was. I don't have it in my history. Yeah. Oh, 47,116. All right. So 19,436.20 minus 15,190. 4335.30 divided by their average payroll, 47,116.67. 0.092. All right. So if this is our reserve ratio, 9.2%. So if the reserve ratio, then we apply that to the table, 8%, between 8% and 9.9%, 4.5%. There we go. Lots of steps here. Rate for 2023 if $2,000 of additional benefits had been charged by mistake to their account. So what we're going to do there, benefits paid would be, this would now be 17,000. So 17,190 because that's an increase in benefits of $2,000. So 19,436.20 minus 17,100.90, 2335.30 divided by 47,116.67 gets our reserve ratio to 4.9%, 4.9%. 4.9, yeah, about 5%. Between 0 and 7.9 is 5.5% contribution rate. So we're going to want to use the total payroll to figure out the average. And again, read carefully because I didn't read carefully that we have to add this. You have to calculate this and then add that to the amount that's already been given to us. Let's see if there's another one that we can take a look at and work a little bit faster here. Different numbers. All right, let's look at this one. Go a little bit faster this time. So again, here's our reserve ratio.